America, unfortunately, still glorifies the Silicon Valley tech entrepreneur that goes from nothing to being a billionaire. And while it may be appealing to some people, it's not reality for most people. And I think if most people stop and examine their life, particularly the type of bootstrap founders that Tyler and I get to know all the time, what they really want is some, financial independence. They want to not work for somebody else. They want to have the freedom to choose who they work with, what they work on, and to live a little bit better life than they have today.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside. Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Jay Klaus, and I'm accompanied by my co-host, Mr. Working From Home himself, Eric Hornung.
Jay, as you know, I am oft on the road. People don't say oft enough, by the way. They always say often, but oft just has such a nice little flavor to it.
You sound like a jerk.
All right. I'm often on the road, and that means that my job is pretty flexible, which means I am oft working at home and not in a cube in New York, which is a whole different perspective.
Which means that your coworkers are friend of the podcast Colleen and friend of the podcast Hank.
That's true. It's the first job I've ever had where I have to regularly feed my coworkers.
I love remote work. No, that's not true. When I was working at Crosschecks, now Olive, I was working in the office, but first startup Tixers was completely remote, and now I guess I'm remote. I just don't have an office.
You have an office. It's just your studio apartment. There's a nice bookshelf that separates your bedroom from your office.
I just realized yesterday that I can refer to my podcasting studio simply as my studio, which is true in more senses than one. Studio apartment, podcasting studio.
Love a good double entendre.
Living the remote life.
Is that what the word double entendre means? Or did I just make that up?
No, that's a dual meaning. Double entendre is much more suggestive. Maybe. I don't know, maybe. Maybe technically it is double entendre. Speaking of remote work, we are talking to two people who are close to remote work today, Tyler Tringas and Kevin McArdle. Tyler Tringas is the general partner at Earnest Capital, which provides early-stage funding, resources, and a network of experienced advisors to bootstrappers, indie hackers, makers, and real businesses. They offer an innovative investment structure aligned with founders and businesses that want to accelerate now and ultimately become a profitable, sustainable business. Kevin McArdle is the co-founder and CEO of SureSwift Capital, which is a holding company that actively invests in and holds on to emerging media and SaaS properties with the intent to provide exceptional value to existing and future clients. They are a team of 75 plus remote workers in 14 time zones, headquartered in Minneapolis, Minnesota. This is going to be an awesome interview, given that Tyler has sold a company to SureSwift Capital in the past, and now in running Earnest Capital, Kevin is an investor in Earnest Capital.
It's going to be an awesome interview for that reason. It's also going to be an awesome interview because it brings up one of the things I love about this podcast more than anything, which is that we get to explore the fringes of startups, startup communities, and startup ecosystems. And one of the fringes that you and I have talked about before with Rob Walling on the show and some companies that have been on that have bootstrapped themselves, like Periodic Edibles, is this outside of traditional venture capital fundraising model. A lot of people call it the bootstrappers movement, or you have Zebras Unite, or there's a couple other players in the space, and it's smaller, but they're definitely making some noise. And I think it's so much fun when we get to have people like this on who are kind of running counter to everything you're reading about in the Wall Street Journal or TechCrunch.
Yeah, Earnest really only got started late 2018, similar time frame to Tiny Seed with Rob Walling. It's wild to me that in exploring these alternative financing models, we will have talked to the majority of people innovating in that space and offering these different instruments, because there's just not that many of them, and they are all so relatively nascent.
I would push back on that a bit. There's not that many of them that are talking about doing it. There may be more that we just can't see or find. They're doing it behind more of a veil.
Yeah, almost certainly. But in absolute numbers, got to be pretty few of them to have a beat on really a small handful. We got Tiny Seed, we have Earnest Capital here, there's Indie VC. What else we got?
Saltwater, I think, is doing something similar out of San Francisco.
Yeah, so not a whole lot and pretty early on. So excited to chat with Tyler and Kevin here. If you guys have any thoughts on this episode as we go through, we'd love for you to tweet at us at UpsideFM or email us hello@upside.fm. And we'll get into that interview right after this.
Hey, what's up, everyone? This is David from the New Money Podcast, where we discuss investing opportunities for everyday people. If you're interested in startups and tech, each episode of the New Money Show explores a different financial product or opportunity that anyone can invest in. These are websites and apps like Betterment and Wealthfront and Acorns, the types of companies you've heard even advertised on podcasts like these. We break down the pros, cons, and trends that we see emerging in this new world of fintech in bite-sized shows that you can listen to every week. So just search New Money in your podcast player and you can tune in. Thanks.
Tyler, welcome to the show.
Hey, Jay, thanks for having me.
And Kevin, welcome to the show.
Thanks. Good to be here.
We have kind of a dilemma here. Usually on Upside, we start with the background of the guest, but today we have two guests. So let's start with one of you. Kevin, can you tell us about the history of Kevin?
Well, the history of Kevin's a bit of a long story because I've got some gray in my beard. So let me just do the last several years. I'm the co-founder and CEO of a company called SureSwift Capital, and we are a holding company. We acquire and operate small technology companies.
And Tyler, can we get the history of Tyler?
Sure. Similarly, I have a tough time sort of compressing it into a short snippet these days. Generally, I tell people my MO has been sort of trying stuff I don't quite know how to do. So I've had a background in finance for a while, taught myself to code, became a freelance programmer, then became a founder of a bootstrap SaaS business, sold that business, and now I run Earnest Capital, which is a early stage fund investing in.
So we have both of you on. Can you, maybe for the listeners, lay the landscape a bit? How do you two collaborate and work together? Like, why do we have both of you on?
So Earnest being a new fund, you need first investors. So I am an investor in Earnest Capital. I mentioned SureSwift is my day job, but I believe strongly that Earnest Capital needed to exist. And I believe that though there are a couple of models that are similar, I think Tyler's makes the most sense. And so when deciding how to help more bootstrappers launch companies in profitable ways, I believe that investing in Earnest was the right thing to do. Fortunately, I also had some history with Tyler. So he mentioned he owned and sold a bootstrapped SaaS company. He happened to sell it to SureSwift. And so we're lucky to operate that company today. I think the transaction was almost 2 years ago, Tyler. And we've remained friends. And so really Tyler gets all the credit for launching Earnest Capital, but I think it started over a Twitter DM conversation where I was sort of venting over the current state of venture capital, overlaid with the narrow view that all accelerators take, where you have to uproot your life and move to a place for 3 months, or you need to happen to live in that place, which limits the number of accelerators you can participate in. And none of that made any sense to me. And it could be because I'm a 40-something guy with 4 kids, and the notion of, okay, if I want to start my company with the assistance of an accelerator, I would need to move to XYZ city for 3 months, and none of that made sense. And so, Tyler, having been a founder, launched a software company, he has kind of a different experience that it's better for him to go into. But I think we shared common frustration of the status quo. I think we shared a common vision for a better future. And fortunately, Tyler, grabbed that idea by the lapels and ran with it. And I was fortunate to just be able to play a role of investor and advisor while Tyler's taken the operational aspects of it.
And Kevin, SureSwift is relatively new itself. You're in Minneapolis. It's a mostly remote company. Can you catch us up to speed on when SureSwift started and how that business got going?
Yeah, SureSwift started about 4 years ago, and it was actually launched in Victoria, British Columbia, where I lived at the time. Myself and 4 partners, had a relatively simple thesis that we could acquire profitable internet-based businesses and operate them with the intent to never sell them. So we've created a portfolio of, currently 26 companies that we're operating, all digital. And you're right, we have a remote first approach. So it's me and two other people in the Minneapolis-St. Paul area. Other than that, we have 80 contractors and employees in 14 time zones around the world.
And what was the impetus of that vision that you and your co-founder had? Why it wasn't something that was common at the time, because it's still not common now. What was the moment that made you guys say, you know what, I bet we could acquire these internet-based startups and profitably run them without changing the team, almost the Berkshire Hathaway model?
Yeah, I really don't like using that comparison because I feel like only an egomaniac would compare themselves to Berkshire Hathaway. I certainly don't. But they are an example of a holding company where they don't intend to sell on a much smaller scale. My partner, my original co-founder, Don, was looking at companies that did exist and have existed for some time. They're maybe less well-known than Berkshire Hathaway, but companies like Constellation Software, Internet Brands, IAC, these are all roll-ups of either websites or software companies or both. And so it was really his vision. We happened to collide where I was at a point in life where I had spent 15 years at a very large, very hard charging enterprise software company and was just ready for a bit of a change and had always wanted to own my own business. He had the idea and convinced me that it made sense. I had the background of operating large teams and a portfolio of business interests. And so, timing was good for both of us to launch into, what wasn't really a common idea at the time, but it also isn't rocket science. We're not inventing some new product or some new technology that has to be proven. We're taking proven businesses and just trying to operate them the same or better than the founders had before.
That's some really helpful background there, Kevin. Tyler, Kevin said that Earnest Capital needed to exist. Why does Earnest Capital need to exist?
Yeah, I would say that, this challenge is a pain point that I personally experienced very vividly. And as I've talked to a number of other kind of bootstrap founders, have heard again and again and again, which is if you go to, so I just got back from Kevin and I just caught up at a conference filled with bootstrap founders. And when you talk to folks who are, let's just say, all reasonably successful operators of bootstrap businesses, that they started between 5 and 10 years ago. And you ask them about the early stages. My personal story is it was incredibly difficult. I peaked at, I think, about $50,000 in credit card debt. I was Googling personal bankruptcy for the first time in my life, wondering if that was like a thing that I should actually explore. I ended up, basically fleeing New York to go live in Southeast Asia and live super duper cheaply so that I could sort of dig my way out and have the kind of bandwidth to grow this tiny little business that was doing $1,000 a month in revenue into something that was ultimately a really successful outcome for me. But it was really hard. And, $50,000 is a lot of credit card debt. It was really stressful. And when you go and talk to successful founders, you hear that all the time. 99% of them say something crazy about massive amounts of credit card debt, living in your parents' basement, businesses dangling by a thread until your uncle writes you a $15,000 check that bails you out. And it's just all pretty chaotic. And so it was a pain point I knew a lot of founders could deal with. And then you start to think about, for how many other potential founders is this just a filter that they never even start, or that's what, kind of kills the dream, super early on, that they just don't have that line of credit, so they just fail, or they have financial dependence, whether it's, a spouse and kids, or, you're paying for other family members' health insurance, or you just have, very substantial negative net worth as a kind of broader family kind of thing. And you just never even consider the idea that you would burn through all your savings and then some on a business idea. And the only option, if you didn't want to do that, was to go the sort of traditional venture route. Basically, the only play you had, if you were someone who needed a bit of capital to get started, was to raise venture capital. And, it's a reasonable solution for that narrow problem, but you're signing up for this whole other host of things that may not fit your goals and priorities and what you want for your business. And so it was just something that I felt like, there was huge sort of pent up demand for, was something that would create more entrepreneurship in the world. And just, I felt was objectively a good thing. The problem is, building a fund is hard. It's not really something you can bootstrap. You really need some of the right confluence of opportunities to get that snowball rolling. And I was fortunate enough that, I sold my business and in one fell swoop sort of got the personal capital I needed to do the process of starting a fund, which people underestimate just how much it takes, not just in terms of the check you have to write, but in terms of having to go, 2-3 years without a salary, having to fly yourself around, doing fundraising, all that sort of stuff. It's really expensive. It's not something you can do on the side. And then, you always also need a sort of anchor investor, someone to sort of step up and say, be the first person to take on that risk. And that's about half the work, is being able to do it yourself and having one person step up and say, yeah, I will be the first one in. Kevin and I found that, both in one kind of fell swoop, where after he acquired my business, we had a really good working relationship. We were trading back and forth ideas and just sort of felt like the opportunity was there to make this happen.
Can you talk about what is driving the debt of these bootstrapped founders? Is it their own personal burn? Are they hiring people? What typically is the journey for why these founders are taking on a mountain of debt until they get to that break point?
Most of the time, it's just runway. It's just about, so there's this really famous talk about the long, slow SaaS ramp of death, which is just that, when you're building software companies, they can become these really powerful, awesome business models with recurring revenue and very predictable and high enterprise value and good sale multiples and all that sort of stuff. But at the very beginning, you're just eking out, month after month, it's just going up just a little bit at a time. And as a founder, you just need to sort of create the runway for yourself first to realize that you're not going to nail the product right out of the gate. So you may have to sort of iterate and build, and you may need to, ditch it and try something new. And that may burn up 6 months of runway. And so if you only had 12, you're done. Now you don't have enough time to launch and get to that sort of break even point at that point. So it's mostly founder runway.
Another common story that I hear, Jay, and I know Tyler's seen this from a lot of different founders, is the future business that they care deeply about is actually a side hustle. And they either have a full-time job or they are running a consulting or freelancing business themselves to pay the bills. And so, the mountain of debt, fortunately, is not, in my experience, is not the more common story. It's the story of what I really care about is this thing over here. And I think that's how I might be able to provide some financial independence for me and my family. Yet I'm spending 5 hours a week on that and spending most of my time on something that I don't care about and really has no future for me, but it has to pay the bills. And I also see a lot of founders who care deeply about their new venture, their new project, and they just right away start raising money because they want to quit their job and they want to do the new thing full time, which is great and it's admirable. And just like Tyler, I celebrate entrepreneurship and I want more of that to happen in the world. But that short-term need for just a little bit of money to pay the bills and for me to live on, unfortunately puts people on a venture path that often I think a lot of founders don't really know what they're signing up for over the long term by taking that early seed money from anybody other than friends and family.
What percentage of bootstrapped SaaS founders are engineers or technical in nature, actually building the product themselves?
I think if you look now at the companies that are, let's say, have some degree of success, that have hit product market fit and are sustainably operating, it seems like a really high percentage of them are technical co-founders. At least one of the founders was able to build the first version of the product. In my instance, I mean, I'm a terrible engineer at the time, but I was able to get a working product and then, get to a point in revenue where I could quickly hire someone who knew what they were doing. But yeah, it's very high. But I think that's reflective of the fact that 5 to 10 years ago, the cost of engineers was really, really high. And there was a really substantial scarcity of folks. So it was a really challenging thing to be able to hire a sort of technical co-founder for anything other than, trying to get into Y Combinator or something like that. These days, I expect that will change going forward. Maybe not substantially. I still think most of the founders that we see, again, have someone technical on the team, or they've managed to figure out some way to have something like that. So they have an engineering firm that's working with them or something like that. It's still really challenging at that very early stage to be paying market rates for a freelance engineer as you're just trying to iterate and kind of get to product market fit. But it's doable, but I would say it's still substantially technical co-founders.
Kevin, I want to jump back to something that you brought up, which is that founders don't know what they're getting themselves into if they take anything that isn't friends and family money. So what are founders getting themselves into if they take institutional money up front?
Well, I guess it's painting with a broad brush because there's lots of different types of investors. And in an ideal scenario, any investor, whether angel or venture or even friends and family, are going to sit down and have an honest conversation with the founder about, here's what the future looks like from my perspective. Does that align with what the future looks like from your perspective? Unfortunately, there's a lot of money sloshing around in the venture space, and there are a lot of really smart and talented people in the world that want to launch new companies. And I don't think that conversation happens as often as it should. So in the normal case, an angel investor or certainly a seed venture investor expects that there will be a next round of funding, and you're going to grow fast enough to raise that Series A, and then at some point raise a Series B. And everybody's looking for 10x returns. But if you actually pencil that math out for the founder, that means selling more and more and more of your company, and you're signing up for what often are unrealistic growth rates. And a little bit of a pause to stop and think, like, is that really what I want? I think America unfortunately still glorifies the Silicon Valley tech entrepreneur that goes from nothing to being a billionaire. And while it may be appealing to some people, it's not reality for most people. And I think if most people stop and examine their life, particularly the type of bootstrap founders that Tyler and I get to know all the time, what they really want is some financial independence. They want to not work for somebody else. They want to have the freedom to choose who they work with, what they work on, and to live a little bit better life than they have today. So there's a lot of gray area between not having a company, working for somebody else, not being financially independent, and being a billionaire. And I think what we're targeting is that massive gray area of outcomes for founders, and more importantly, reasonable outcomes for businesses. It is really hard to find a business that can turn into a billion-dollar enterprise. Unfortunately, they are so glorified. We hear there's going to be 20 IPOs coming out of Silicon Valley in the next quarter, but people don't talk about the 20,000 businesses that have failed in the last several years that everybody wanted to be the next unicorn. So, it's not true of all venture. I have friends who are venture capitalists who do things the right way, and they have either reasonable expectations or they make sure the founders know what they're signing up for. But I think they are the exception rather than the rule.
The word Kevin and I use a lot, which it comes off as a little bit kind of corporate speak, but I think it's really the best word for this is just being aligned, right? So understanding what the outcomes you're trying to get as sort of professional capital, you have a specific set of outcomes that you are trying to achieve, and you go to other investors and tell them this is what we're going to achieve, and you need to make sure that is aligned with what the founders actually want. So friends and family, it's not professional capital, right? They're just there to support you and to help you, whatever you want to do. They just want to help you make your dreams happen. But if you're dealing with professional capital, you need to make sure that you're aligned with the same kind of outcome. And for better, for worse, and look, I don't think either Kevin or I would describe ourselves as anti-venture capital, right? But it is a very sort of niche financial product that is for, and every good venture capitalist would agree with these statements, that it is for a very small subset of entrepreneurs, for a very small subset of potential business opportunities that have a really extreme risk, extreme reward set of probabilities. And if you don't fall into that, there actually really isn't many options that are actually aligned with your outcome. So what happens is you either don't know what you're signing up for as a founder, or you kind of contort yourself and what you want to do to say, they come at you and say, how's this $1 billion business? And you say, well, I hadn't thought about, it could be this. And then all of a sudden, that's what you signed up to do for the next 5 to 10 years. So it's just very important that you are really clear that you're actually aligned together as investors and founders.
Well, if we're being really honest, I think we're unfairly painting founders as the misinformed group in this scenario. And actually, I think there are some really smart founders who know they don't want to build the next Facebook. They just want to quit their job and work on something they care about. So they do. They craft the story that VCs want to hear, which is, I can grow this to be a mammoth company. But in the back of their mind, they know, maybe not, but this is what I need to do to get the money. And right away, you've got misalignment of expectations and outcomes. So I do think unfortunately, VC is a game that people play both directions, and every once in a while it works out, but all too often I see it not working out. And that's one of the reasons why I thought something like Earnest needed to exist in the world, if for no other reason, just so that people recognize there are different ways to build a good company and maybe change the conversation about what a good company is or even what a great company is, because Tyler built a great company. I don't acquire bad companies. And, as far as I know, it never hit the cover of TechCrunch that he built and sold this really great company. And now I operate it and I love it. And it just flies under the radar, and 99.999% of the population has never heard of it and will never hear of it. Doesn't mean it's not a great company.
Tyler, when you sold that, I imagine it must have been cash flowing pretty well. So what made you want to sell the company?
It's a good question. And 10 seconds of Googling will find a sort of magnum opus on the topic. I wrote like a 10,000 word piece about why I sold my bootstrap SaaS business. But I mean, the upshot of it was that I felt that I wanted to sort of just kind of level up into something a little bit riskier, to be honest. I felt like it was great. It had sort of served its purpose for me. Like exactly those motivations that Kevin was describing earlier were what got me into wanting to build my first business, was to just reclaim control over my time, to decouple, my income from just kind of hourly work, and to also give me kind of location independence. And we took advantage of that. I mean, I spent, of those 5 years I was running my business, I spent probably 3 as kind of a digital nomad, backpacking, traveling around. My then girlfriend, now wife, and I were able to take a year of just traveling around the world together while I was running the business, growing the team, kind of getting myself out of the day-to-day. And I really enjoyed that process. And I had this sort of hunch. I wasn't exactly thinking that I would start Earnest, but I thought, there was a couple things that I could do with the kind of lump sum capital rather than just kind of continue running the business. And I also felt like increasingly the opportunities for the small team that I had built were that there just weren't sort of upward opportunities for them. And that's something you hit a lot in kind of smaller bootstrap businesses, is that you have really talented people who've been working with you for a couple of years, and there's nowhere to promote them to. There's nowhere to even sort of try out something different, like to go work on a different product or something like that. And so I wanted to sort of create those outcomes for them, which has been the case inside of SureSwift. The whole team is still there. They're continuing to still, do great work, and they found a lot of opportunities. But yeah, at the end of the day, it was about, just sort of finding a better home for the business and trying something new.
And Kevin, you've mentioned a couple of times that you're operating that business now. Just as a look into SureSwift, what's the process of, you bought Tyler's company, now you're operating it. What was the steps, and what does it look like now? How do you operate this without the founder?
Well, someday I hope to publish a magnum opus on our process, because I get that question a lot. But rule number 1 is just don't screw up what's working. We only acquire successful, profitable companies. And so we don't want to mess up what the founders had going. So we typically ask the founder to do a bit of a transitional period, 3-6 months, whatever's appropriate for them in their life circumstances, as well as the business itself. Because in the best cases, and Tyler's was one, but almost all the founders we've bought businesses from, they want their business to succeed after they're gone, and they are willing to invest some time and energy in making that happen. And so we took over the operations of the business. There's some boring mechanics of just transferring all the dozens of accounts that are required to manage any business. But then quickly we move into getting to know the team, sitting in on some of the operational conversations and meetings, learning about the customer base. We spend a lot of time with the founder trying to understand, why did you make these past decisions? Not in a critical way, but just so we can kind of climb into their mindset and understand the business from that perspective. And then we'll talk about, okay, if you were to operate this business for the next 2 years, what would you do? If money weren't a constraint, what would you do? Would you hire more developers? Would you hire more customer happiness people? I see that you're only paying this engineer for 20 hours a week of work. Is that because that's all that's needed, or is it because you wanted to take home a little more money? We have those conversations. And as my really talented team of people get to know the team running the business, we might have some ideas of our own. Every single business that we've acquired that came with the team always has really good ideas that they either maybe were afraid to share with the founder, or they did share with the founder, but the idea didn't get executed for whatever reason. So we listen to those things a lot. And we look for growth opportunities for the business, certainly, but as Tyler mentioned, for the team. So there's a woman who was managing support, or what we call customer happiness, for Tyler, who's super talented and was doing a great job. And she is now effectively running the business and doing most of what Tyler had been doing, because his moving on from the business created an opportunity. And in the 6 months of early transition, getting to know Iris, we found out that, wow, she's really capable, and we need to try to challenge her and give her more things to do. So that's just one story of 26, and each one has some kind of interesting components to it. But the thing that where it's not, Tyler and I did not just remain friends because we like hanging out together. It's because we had a really effective and mutually beneficial business relationship. And so that laid the seeds for what we both expect will be an effective and mutually beneficial business relationship with Earnest. And the founders that I remain the closest with, it's all the same situation. They really invest the time and energy to help SureSwift be successful with their company after the fact.
Tyler, how do you feel about the fact that your company is now being run by someone else, and by someone that you kind of put in place with? Iris was her name, I believe.
Yeah, I mean, it's fantastic. Unequivocal 2 thumbs up. It's a great outcome. That's the best possible sort of transition scenario you can ask for, is that everything goes well for the team, everything goes well for the customers. The idea is that, the business is going to stay as is forever and hopefully get better along the same trajectory. But it's, when you think about, people buying these businesses to gut them and try to make them as profitable as possible by firing everyone, that's a horrible outcome. When you think about people buying businesses to sunset them and screwing over all the customers, that's a terrible outcome. Yeah, I mean, I couldn't be happier with what's happened with the product, for sure.
I want to transition a little bit back to Earnest Capital and your guys' investments. Kevin said that I think he said it a couple times now, they invest in profitable, successful businesses. VC in general kind of invests in these boom or bust businesses where it's 0 or it's $1 billion. That's kind of the outcomes. I see you guys sitting in the middle in that gray area that we talked about, but I want to hear kind of how you think about company failure and what the rates are for companies that you invest in that fail.
It's one of those things where I would say it's one of the central bets of what we're doing, and also something for which there is almost no data, in the sense of, there's something approximating a data set, although it's quite hotly contested for the failure rates of, let's say, seed venture funds. And you'll get numbers anywhere from 60 to 90% are things that people will say. And it's partly the fact that these are all private companies, and the data is all self-reported, and then everybody has a huge incentive to inflate their own success rate and all that. So it's very unclear what the actual kind of benchmark is. But our sort of basic theory is that the failure rates of the companies we back should be lower. And the reason is that I think venture capital, when you raise that first round, you're sat down and said, okay, you've raised your seed round, you need to raise a Series A. And here's what the market needs to see to raise a Series A, right? And that's going to be, like you hear the folks at Y Combinator talk about 7% week over week growth, right? There's all kinds of these benchmarks that are like, you need to hit this. Otherwise, in 12 to 18 months, you're going to be out of money and no one's going to write you another check. And so that sets up a series of incentives that, to me, all point in one direction, which is to sort of shift the risk curve in one direction, which is, let's go big or go home, right? So let's hire those engineers a little bit earlier than we think we need them, because we think that will increase our chance of, hitting those growth milestones. Let's customer acquisition strategies that maybe are starting to be not our most profitable or our cheapest customer acquisition strategies, but they do get that growth rate going, right? And so most of these early stage startups, they tend to sort of fail from over investing in the wrong thing. And I think that's the incentive. If the idea is, look, you've got this check, now it's a race to the next milestone. And our view is, hey, we're totally fine, because we really want to be the only round you ever raise. Now, it's not a rule or anything, and we put in all kinds of flexibility in our structure so that if you decide you want to raise a big round or you want to raise a private equity round, all kinds of stuff is fine. But our sort of, center of the bullseye is we're going to write a small check early stage to fund mostly your runway to kind of get to break even. And that's going to be fine. You build the business from there. And that lets the founder make trade-offs that optimize sustainability over kind of growth at all costs. And so our kind of basic bet is, hey, we might not get a unicorn out of this portfolio, but we will more likely have a sort of portfolio of singles, doubles, and triples rather than a bunch of strikeouts and one or two home runs that are the sort of fund makers. So our basic bet is that bootstrap founders fail a lot less frequently, and anecdotally that seems to be the case, but there is no data set. We don't know how much survivorship bias there is. Nobody writes blog posts. These days, actually, some people do write blog posts about their failed bootstrap businesses, but it's hard to collect that data still.
As an LP, if I'm looking at you or a venture capital firm who's in a similar kind of position, are expected returns similar with a lower failure rate, or like how does that play out? Because they have this kind of go big or go home mindset.
Okay, when you talk about this general area of discussion, you have to start from what I said before, which is that the data on the venture capital industry is both kind of ridiculous and also hotly contested, right? So if your benchmark is how well are you going to do against VC, and you look at the Cambridge data or the NVCA data and you say, okay, well, the median venture firm returns less than 1x their investors' capital over the 10 years of the fund. The average venture firm from 7 years ago has still not even returned 1x capital. And it only takes, if you return 2 times your investor money, which is still pretty much like the same as stock market returns over 10 years, then you're already in the top 20% of all venture firms. If that's the point of reference, which is what the data seems to say, which says a lot more about the venture capital industry than it does about our model, then the returns look great. It's really not actually a spectacularly high hurdle. Because, and the reason I think is that investing in early stage companies is hard. It is challenging. And so one of the things that we've tried to do is to say, okay, let's take it on faith that just, picking companies very early stages is hard. What we've tried to do is say, we're going to try to get good at picking. But also what we've tried to do is to move that line for success kind of further to the left. So if you say the distribution of outcomes is going to be fixed, really hard. You say, we want more of those outcomes to be successful for us. So if you look at the way that we've kind of set up our model and you compare it to some bootstrap entrepreneurs, sometimes you'll have 1 or 2 founders and they build a product, that's built on an app store or something like that. And it's just the 2 of them. And over the course of 6 or 7 years, they grow it to where it's making $300,000 per founder. And it's still just the 2 of them, and this is just a terrible zombie in the portfolio of a venture capital firm. For us, we actually get a pretty good return on that. We're totally okay with that kind of an outcome. And we structure it so that we're aligned with that, so that, whereas maybe we even get the same as a venture firm, but actually 4 out of 10 of those would be just outright failures. They would have said, just return the money, start over again, shut it down, go try something else. We actually get a pretty reasonable return out of it. So that's been our approach so far.
You know who else gets a good return? The founders and the employees of that business, if they ever grow beyond the 2 founders. And that's something that always bothers me, but I don't think people talk about enough is, venture has a 1 in 20 success rate. They want 1 or maybe 2 out of 20 to 2 out of 20 bets to pay off the whole fund. Well, what happens to those 18 or 19 other founders and their teams when they were told, go spend money as fast as you can, hire as fast as you can, get customers as fast as you can, and then as soon as the trajectory is not favorable for the next round, it's a failure. So what unfortunately venture does is kill what could be otherwise profitable and healthy companies. And I don't think that gets enough of the discussion. People talk about the amount of money burned up, but hopefully the money that's overcompensated by the few IPOs that exist. Well, there's timelines of careers that are built up. There's, the livelihood and the stress level of venture-backed founders that get burned up in the process. And there's the early employees who, take a bet with their own life and career on a funded startup because they believe the myth that, anybody can be the next Facebook. And their timelines get burnt up and their income gets burnt up because they're given equity in this rising company in exchange for the salary that they actually probably deserve. So one of the reasons why I wanted this to exist is not just because I think there's a compelling case that it's a sound investment, and it is. I believe it's a healthier way to grow businesses. It's a healthier way to incent founders who do have a good idea. It's a healthier way to build sustainable businesses that will employ a lot of people, hopefully make founders rich, hopefully pay back Earnest and myself and the other LPs. And to me, it just makes so much sense that I'm surprised it hasn't existed until now.
Tyler, something I saw on the Earnest website is you guys have a returns cap based on your shared earnings agreement. If the founder has some level of success, you actually have a cap when you invest, to my understanding, of when we get this return, we're no longer taking returns from the company. Am I understanding that correctly?
A little bit. So it was a sort of double-edged process that we ran, which is when I was first kind of workshopping this idea of the shared earnings agreement back in, let's say, September, October of last year, I sat down on a whiteboard, essentially. I mean, not literally, but I kind of surveyed the options out there for financing instruments and just felt like there wasn't anything that actually got us to this main objective, which is sort of, let's be aligned with founders, right? So the North Star has always been, what would I want as a founder? What kind of deal would I have taken? And all the many founders I've met over the years, what would they have wanted? And so I had a bit of a background in finance. So I said, let's just do this kind of from first principles and see what we come up with. And I started shopping this around, talking to investors, and said, hey, look, I think founders are really going to like this. I think this is very aligned with the outcomes they want. And a couple of them said, well, how do you know? How do you know they want it? Okay, fair enough. I don't. So let's publish it. So I made the Earnest website. I put up one blog post saying, hey, here's the kind of basic thinking behind this. Here's the draft term sheet in Google Docs with the comments open, and we put it up on Indie Hackers and Hacker News and on Twitter and everywhere. And I was sort of expecting a couple people to weigh in, but actually like thousands of people weighed in, everything from hundreds of comments in line inside the Google Doc. It was turning into its own little almost, forum thread after thread on individual lines. And I got tons and tons of feedback on it. One of the central questions I asked there was, should this be fully capped, where there is a hard cap as a founder, this is the maximum amount that you will ever pay? Or should there be a sort of long-term component that keeps us aligned, all the way till the end, whether you keep the business forever or you eventually want to sell it? And there was a resounding feedback from both investors and founders for the latter. So where we've ended up is that there's essentially kind of two pieces to the investment. The first one is designed around aligning us with this kind of, you build the business to a particular level of profitability. And as a founder, you want to start kind of taking some money off the table. So, and this is something that you see, and it's something that a lot of founders want, is I want to build this business up to $2 to $5 million in annual revenue. And then I want to make up for the fact that I've been paying myself crap for the last 5 years. And I want to pay myself $300,000, $400,000, $500,000 a year in salary and dividends. And so what we have is a shared earnings agreement, which is, as you kind of generate that benefit for yourself, we get a percentage of that. So we're like, high five, that's amazing. Keep that up. And that piece is capped, right? So we say, look, at a certain point, you're going to pay us back a multiple of what we've invested. And then you can continue running the business profitably forever and not pay us another dollar. But we also have the kind of second component, which is essentially an option. If you ever sell the business, or actually if you decide to go raise a big round of financing somewhere way down the line, we kind of get a piece of that. And it's a small percentage and it's not capped. So if you do end up building the business and bootstrapping it to be a multi-billion-dollar company, we do get a sort of substantially outsized outcome as well. And what that does is just keep us in the game, right? Because we thought about it and we said, okay, once we get sort of 75% of the way towards our cap, are we going to stop really caring about this company? Because we're pretty much going to get there and it'll be fine. Now it's like, you've got Earnest, you've got our whole group of folks who are mentors, who are also invested in the fund, which means they're invested in your company. 11 years from now, you have a $250 million acquisition offer on the table, and you want everybody on a conference call to help you maximize that outcome. We're going to be there. So that's the reason for that.
Jay, that touches on a component of Earnest that we haven't really talked about, which is the mentorship and accelerator component of it that Tyler's better to talk through. But when I talk to founders, that's as important to them as to some of them as the funding, because we're not just writing checks and saying, hey, give me an update next month.
Yeah. I mean, this has been it's been both by design and necessity that the fund, Earnest, is essentially composed of successful operators and founders, most of them sort of bootstrapped owners that have either exited a business or built a really healthy, sort of profitable business. And that turns out to be the right folks to back something like this because they intuitively understand the risk profile here, but they're also tremendously helpful. Every single person has said, look, I don't want this to be a hands-off thing. I want to allocate some amount of time. It varies, by founders. Some people are still operating very busy businesses, and other folks have, had 3 or 4 exits, and they're happy to spend a couple of days a week working on this kind of stuff. But yeah, there's about 30 or so really experienced founders who are mentors. And early on, as we were talking to, I talked to probably 200 or 300 folks about mentorship because I really wanted to get that piece right. And I said, tell me about how mentorship went well or went badly in your life from both sides of the table as a mentor and a mentee. And it turns out a lot of people have horror stories about mentorship. And one of the sort of themes that I sort of found through those conversations was one, it's very difficult to sustain a mentorship relationship over time. And 2, the best version of that seems to be to have skin in the game. Right. So you hear again and again, like people who get a mentor, they go through a local accelerator, they get a mentor assigned to them for 3 months. And then a year and a half later, they can't get them to respond to their emails or pick up the phone. And on the other side, actually, when you have someone who's actually invested in your company, that tends to keep them on board. So we made a rule early on, which is all mentors have to have skin in the game. So they have to actually be, a little bit at risk and long-term a part of this journey for you. And it's been great. I mean, I get to dog food the mentorship group myself because they're all my mentors right now. And I'm actually incredibly jealous of the founders who get access to these folks. I mean, they're just really knocking down obstacles for me and have been tremendously helpful as we've been launching it.
I see on the website that you guys typically invest $75,000 to $250,000. When was the first check deployed? And how many have you deployed since then?
This week.
First check was this week?
Yeah.
Amazing.
You're getting the scoop, Jay.
Yeah.
I love when that happens on Upside.
Yeah.
Congrats. So talk to me about that decision. What went into choosing that company?
Well, I mean, frankly, we've gotten hundreds of folks who have actually applied. So we went ahead and put up an application form. I don't love the idea of, applying per se, but it just, I was asking the same questions as people would email me in, and I would send them the same 6 or 7 questions, which is, okay, look, I'm going to put this form here. It's the first 7 questions I'm going to ask you anyway. So just let's start here and go ahead and send those through, and then we can skip through that. We've had several hundred folks do that, and still another several hundred folks who have just sort of emailed or been referred or introed by someone else. So it's a pretty massive pipeline. And within that, I've been really pleasantly surprised to see how many of these founders are just directly on our thesis, because we really have a sense of what is the current universe of people out there who are working at this very early stage. And it turns out a lot of them are right exactly where we want. So it's folks from all over, so we're logistically able to invest kind of with a pretty wide range. We can invest in the US, Canada, EU, Australia, New Zealand, all kinds of places. We're getting applications from folks who are outside the major tech hubs. And so that's been really great. We're getting a lot of folks who are right at that exact moment where the kind of capital we're providing is really needed. So you're at $2,000, $3,000, $4,000 a month in revenue. It's growing fast, but you don't have a lot of savings, or you have financial dependence or something, and you can't just go full time on that amount of money. You're still 6 to 8 months away. And so we're very happy to write a check to bridge you into that. And then we're getting a pattern that I really love, which is folks who have a sort of career background in a particular vertical that they now are applying software to. And so we're seeing a number of applications like that. And so the first couple of checks that we write are like exactly in all of those check boxes, at that moment in time, that sort of, trajectory, they're right there. And we've got, I would say, quite a few more right behind them. We haven't decided to do it in a sort of, Y Combinator style batch kind of approach, but it's going to turn into that because we've just got just a lot of opportunities right now. And it makes sense to sort of deploy that fairly quickly and then take a step back and see how they're doing.
I want to jump into this idea of open sourcing your terms real quick. I think that is like phenomenal, putting that out on Google Docs. I'm curious if there was a term that sticks out to you that was super popular that didn't get incorporated into the current version of the agreement.
Like something that was suggested by others?
Yeah, like a lot. Like one term that sticks out, like, and you're like, we just can't do it for X, Y, or Z reasons.
There was a lot of suggestions, I would say mostly more from investors and later stage founders to do revenue-based financing. And I mean, the reason why we decided not to go down that road is that I don't think it's a fit for the sort of very early stage companies, in the sense that, you know, revenue-based financing is not the sort of founder earnings-based financing that we have aligns us with the actual founders' decision-making, where sometimes it may not be the best time, you know, a year later to start kind of taking money right out of the business. You might be right at an inflection point. You've got a customer acquisition channel that's going really well, and it makes sense to just plow as much money as you possibly can. And maybe even as the founder, I'm gonna make some sacrifices and eat ramen for 6 months because we're just crushing it on Facebook ads, and I can see the lifetime value, you know, of these new customers is great, but I'm kind of constrained for cash flow. And that's, you know, a terrible time to start taking out a chunk of your revenue. So we're basically fine taking that kind of time frame risk and just saying, hey, look, you as the founder can make those decisions. My every bit of sort of complexity that we added into the terms, because, you know, I'll be honest, like, we're not exactly winning on the complexity side of things. Like a safe is really easy to understand, or a convertible note, and it takes a little longer to understand our terms. And so why did we do that? For me, it was this continual process of making sure that we would have, you know, founders or experts or investors who would just red team every possible situation. And in every situation, I didn't want to say what's the best for us as the investor. I want to say, how can we be perfectly aligned with the founder? Where, okay, like, you as a founder want to do this in this situation. How can we be like, okay, that's great. That's good for us. It's everything. All the numbers are moving in the right direction. If you're making good decisions as a founder, there's no way you can be aligned with, you know, with poor decisions. And that can always, you know, hurt both the investor and the founder. But it was just that process of saying at every turn, how can we say, yeah, I mean, that as long as you're making the right decisions, we're going to be along for the ride and not have our sort of investments diverge, for example, or our interests diverge. Like one example, I'll give you an example that I heard a lot, because I talked to a bunch of founders who were sort of in the kind of bootstrapped world. Maybe they had a success already, and so they were actually able to raise some money just from not quite friends and family, but professional friends and families, other founders, stuff like that. There was kind of a wave of folks in the last kind of 2 to 5 years that they were able to raise, say, 200 to 500K just kind of out of the gate to get started. And they weren't saying, hey, you know, this is a venture round. They just wanted to raise some funding because they were sort of proven entrepreneurs. And a number of them did it so just, you know, for just either equity or a sort of convertible note where they kind of raise that round. And now they have these investors that have, let's say, plus or minus like 10% interest in the business. Now they're at that phase I was talking about earlier, right? Where you have a couple $1 million a year in revenue. You want to just start harvesting out some profits. So they're saying, hey, maybe, you know, as a founder, we're going to issue like a 500K dividend, right? Because we want to pay ourselves. And the investors are sitting there saying, okay, wait a minute. We have 10% of dividends. So for every dollar that you issue in dividends, 90 cents of that is going to come out of the business and into your checking account or into your Wealthfront account or something. And 10 cents of that are going to come to us. Wait a minute, maybe you should just keep that whole dollar in the business and grow it. Like, we would really strongly prefer that you do that. And that's just kind of a situation where it's like, okay, the interests are not aligned there. And that's a pretty likely outcome. So why don't we try to structure around that so that we're happy with that? And so that's kind of where we arrived at, say, taking a larger share of founder earnings, but then actually saying it's capped, right? And so that's kind of how we backed into some of those decisions.
Is Earnest investing out of a fund that is raised? And you're like, this is fund one of Earnest Capital, or is this kind of an ongoing, almost deal by deal sort of situation?
Yeah, Earnest is a fund. We run the company on AngelList. It's not super well known, but they have a product that does the back office for funds. Yeah, we have capital that we deploy. Basically, I'm the GP, and I'm able to just do deals. It's not a syndicate where, you know, we have an idea and we take it back to a bunch of investors, and then they all opt in on a case by case basis.
this kind of gets into my question, which is future casting a bit. We just signed our first check, but let's look forward. What are the success metrics for raising Fund 2 from a investor side? Because you have this kind of time lapse thing, and there's no next round for valuation that you can say, look, I'm doing so good because these companies raised a Series A. So I'm curious to hear from Kevin as an investor, what are you looking for from Earnest Capital if they want to come out and raise a second round?
Well, I actually think Tyler will be able to mark the current value of the portfolio, but it'll be based on real things like revenue and profit versus customer acquisition costs and customer growth. Not that those aren't real numbers, but it doesn't necessarily translate to the actual value of a business. So I think, Tyler mentioned earlier, we as a group, but in particular he, needs to be good at picking the right investments. And there will be a lot of kind of discussion and subjective value put on those. Like, did Fund 1 make the right number and quality of investments? And as an investor, I have a bit of an advantage in, having, acquired 32 businesses in 4 years, and we still operate 26 of those. And I have a little bit more of a clear view of kind of what works and what doesn't than the average LP. And our LPs are all really smart, talented people who have built their own businesses. So I think they'll have a pretty sound view of that versus somebody just writing a check into an angel fund or something like that. And a measure of success for me, and I'm not sure if this is what you're asking, Eric, but I think I'm thrilled with the LPs that have come together to launch Earnest Capital. And I'm surprised and impressed with the number and the quality of people who have invested in this idea, because I believed in it, but you never know if other people are going to. And clearly other people way smarter than me and with way more money than me believe that this is a good idea. So to me, that's a good signal. That said, I believe Fund 2 will be, or even later Fund 1, a measure of success will be if LPs come from outside this sort of bootstrapping entrepreneurial community. And if Tyler is able to secure checks from what you would consider bigger or more institutional investors, the type of people who are writing checks into, more traditional venture capital, private equity, et cetera, that have very large pools of money to invest. And they see this as just another angle on good, sound investing. And so just any sort of checks from larger, more institutional investors, I think will be a good signal. And the more of those investors there are, the larger the checks, of course, that's an even better signal. I think we realistically knew that because this is new, because it's a narrow niche of bootstrapping, it's a different investment thesis, it's a different return model. We kind of had a hunch that it would be people who get it that invest first, and that has played out. And I believe as this becomes more commonly known, as we see good results, as we make good investments, if we are successful, it will break out of that group of people that inherently get what it means to aim at profitability versus aiming at growth.
This has been great, guys. Thank you so much for taking the time today and sharing about this. We're excited to follow the Earnest Capital journey. Tyler, we'll start with you. If people want to learn more about you or Earnest Capital, where should they go?
So, earnestcapital.com is the best place to find us. We're Earn, EARN, like earning money. Yeah, so we're the same on Twitter. Those are the two best places to keep in touch. And similarly, I'm Tyler Tringas, both on Twitter and tylertringas.com as well.
And Kevin, if people want to learn more about you or the work that you do at SureSwift, where should they go?
Yeah, SureSwiftCapital.com is the website. I'm just Kevin at SureSwiftCapital.com and happy to get emails from anybody who's interested. On Twitter, I am Kevin_McArdle, and it's McArdle with one C, not two.
So Jay, we just spoke with Kevin and Tyler of SureSwift and Earnest Capital, respectively. Another one in our series of alternative financings. What are you thinking? What are your hot takes or lukewarm takes or freezing cold takes? Really, whatever takes you got for me.
How would you rate the temperature of my takes on average?
On average, Celsius or Fahrenheit?
Kelvin.
I'll go Fahrenheit because I don't know what a Kelvin is. So if 0 is freezing cold or 32 is freezing cold and 212 is boiling hot, I'd say you're like a solid balmy 66.
Seems low. Seems low. All right. Then again, I don't know if we want really hot takes. Do we want hot takes? In the world of hot takes, what do you want? Do you want to be hotter or colder?
In the world of hot takes, I think you want to be hotter.
Okay, so that was an insult.
It was an insult, but if I was going to be serious, I'd say your takes on average are like somewhere around, 104 degrees. I think that's about fair. Warm enough. Like if I was going to put some J-style takes in my tea, I would be like, well, this is warm, but it could be warmer.
Okay. Well, this is one of those conversations that throughout it, I felt myself getting a lot of energy. Like I was almost bouncing over here on this stool with how in agreement I was on a lot of the things that Kevin and Tyler said from an ethos standpoint, from an idea of aligning the investors with the founders. And even though I had a little bit of the voice in the back of my head that I feel like I've been honing on this show a little bit of, seems like there's money being left on the table. Like there is part of that in the back of my head, like seems like you're probably leaving some money on the table as an investor. I think it's okay because that voice that's saying I think there's some money on the table is exactly the voice of what brings investors and founders out of alignment, which is exactly what they're saying Earnest Capital was built to not do. I love the idea of open sourcing the shared earnings agreement and getting lots of comments on it from the community. I love that the two of these guys have this partnership that was born out of Tyler's company being sold to Kevin's company. So like they did the first version of this in a way. What did you think?
I would agree with all of those points. I, as you know, love great incentive alignment. So whenever incentives are aligned, I think that is, there's a great Munger quote about that I'll definitely botch if I try to do it. So I'll do it anyway. I think it's something along the lines of study the incentives and nothing else matters, or study the incentives and I can tell you the result, something along those lines. And I think the incentives here are really lined up well. And I think when you look at the other side of the table at VC incentives, those can be a bit skewed, and you see some of the results of that skewedness.
Kevin brought something up that really stuck with me when he was talking about the story that's not told a lot of times in venture is the story of the teams and the employees of these companies that are forced into a high growth trajectory. Then that company, quote, fails because it didn't reach the high growth potential. And those employees are sort of a casualty to that. And I saw that. I kind of experienced that when I was at Crosschecks. Now Olive, still existing, still trying to get to their $1 billion outcome. At one point, we were post Series C, and we came in one Monday morning and were told that 20% of the company was going to be let go. And they were that day. And it was a strange, hard, surreal day experience. And the fallout of that was also really weird because suddenly a lot of the people that you were very close to are just gone. It felt a lot like what I would imagine talking somebody out of breaking up with you felt like when you were still there. Like it didn't quite feel cool. And that's very much a reality for a lot of these companies. And something, I think there's a lot that people talk about with the future of work. And I think Kevin is in the middle of this. I know you're interested in talking to him more about it. A lot of that comes from the standpoint of loyalty between employee and company. And things like that are what spur a movement away from loyalty between those two parties.
I've heard before, just talking to some people who have been in business, who started businesses, not your startup type businesses, but, a company that you're starting. Actually, I'm talking specifically about a company in Cleveland, Ohio, where whenever someone started a company, and he started, I think it's something like 18 companies at this point, your local dry cleaner, whatever, he always gives 40% equity away because it aligns incentives better. And I think that kind of gets to this gap between, all right, I'm the employer, you're the employee. Now it's like, hey, we're all thinking with a shareholder's mindset. How can we make this better? Which I think is fascinating. And one other thing I want to touch on is you talked about when these companies fail, employees can be
casualties.
That's a harsh word, but yeah, sure, we'll go with casualties. I think they can also be victims when companies succeed, even founders. So if we look at the Box IPO'd for over $1 billion, huge company, right? But because of this like late stage capital that keeps on coming in and diluting the earliest people, I had just heard this on Meb Faber's podcast where the CEO of Box, the New York Times was going to do this piece on him on how rich he's going to be now that they're getting IPO'd. And the number was still very large. It was, $50 million, $100 million or something like that. But they were shocked by how little it was, how little of the company owned. He owned like 4.9% of the company because there was so many rounds of financing that diluted him down because that's what you need in today's like venture capital environment. The Lyft founders, for example, I think they own under 10% of their company, because you have this huge money moving in that's just like changing the incentives. So yes, you're going to own 10% of a $100 billion company, and that's awesome. And that's amazing, right? Like that sounds like a big win, but there's also like the flip side where I think Andy Sparks said it best might have been quoting someone in our panel where he said that VC kills more companies than it creates. And a lot more people are ending up on your side of the fence as opposed to what I was just talking about.
And you're talking about the founders. I mean, I have good friends who were fairly early employees of Uber, for example, waiting for the IPO to see if their stock options were a tasty little bonus. But as more and more time passed and they were working in this toxic company that was burning them out, and they weren't sure if and when it was ever going to IPO and what that value would even be when it did, that sounded like a nightmare to me.
Yeah, and then once it happens, you have a 6-month lockup on the IPO, so you have to stay around, and then everyone sells their shares 6 months in, so the stock crashes and it's worth less than you thought it was anyway.
We could probably spend another 30 minutes talking about both SureSwift Capital, which I think is a fascinating model, and I really like the ethos of that business, as well as Earnest Capital, but I want to spend a little bit of time comparing this with a previous conversation we had with Rob Walling in Tiny Seed. Do you think that, I'm just going to put you on the hot spot, do you think that Earnest Capital can work?
Yeah, I mean, I think it could work. It's going to come down to failure rates, right? And what is the return I'm getting on my investment as an investor? Because there are people like Kevin who are driven by this mission, and it sounds like most of his LPs are driven by this mission, and that'll get you through fund 1, maybe fund 2. But eventually there are going to have to be returns if this type of investing is going to take off, because Earnest Capital can't be just Earnest Capital and be the only people doing this. There will be copycat funds. There will be people who come in with a very similar thing or take his agreement and say, we're going to do the same thing, but we're going to do it in this specific space. Maybe we'll do it in media. Maybe we'll do it in sports. Maybe we'll do it in whatever. But that's only going to work if you can prove that this community, this mentorship, everything that they're doing actually leads to lower failure rates, because that's going to need to balance out when you're not hitting these 10x type deals.
Yeah, I agree. They're going to have to show that the model works. Something else that kept popping up through the interview with that voice that said you might be leaving something on the table. I kept thinking, well, if I'm an LP, why wouldn't I invest in something that seems to have a more sure model of returns and has the kind of big and boom and bust type returns? Am I really going to buy into this aggregate, fewer failure, similar returns profile model? And at the end of the day, they need what? A couple dozen LPs to keep doing this fund after fund. You can probably find those people. And especially if it is ethos aligned, you can probably find those people. But to your point, I wasn't thinking about the copycat funds. So they will have to prove that they can defensively continue to pick good companies and attract good companies. Because if somebody copycats this and has a stronger pool of mentors or a more specialized pool of mentors, as a bootstrap founder, I'm probably going to go there. You know, if I'm building a B2B SaaS company, I might be looking at what Rob's doing. So it'll be interesting to see how this plays out. Like we said in the intro, not a lot of companies playing in this type of financing space that we're aware of yet. And it's kind of fun to have a front seat to this grand experiment in real time.
We talk about it all the time. Innovating on structure is harder than innovating on content. And I love when we get to check out these type of financings because they are innovating on structure, which is hard and unique.
All right, guys, I'm sure you guys have a lot of thoughts too. We'd love to hear them. You can tweet at us at UpsideFM or email us hello@upside.fm. If you're aware of more companies playing in the alternative financing space, we'd love to hear about them. That's another thing that you can email to us, hello@upside.fm, or tweet at us at UpsideFM. We'll talk to you next week. That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter at UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside Podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well, I'ma keep on rhyming.